Welcome to the VC React podcast. Every week, we bring you insights and reactions from top VCs, reacting to weekly news on startups, VC funds, and investment rounds. In today's episode, we will talk about why some family offices decided to launch their own VC firm instead of investing in other funds as LPs. Is that good or bad for them, for startups, for fund managers? We will also discuss the merger between two of Africa's largest B2B e-commerce platforms and how the new company will navigate the fragmented and complex market of Africa. And finally, we will have a conversation on the $10 million round at an $80 million valuation for a Web3 streaming company in Dubai, and how the round was partially raised on an equity crowdfunding platform in the US. We have a great episode for you today with three remarkable VCs. Ali Majthoob, Managing Director at MEVP, Hasan Zainal, Managing Partner at Arzan VC, and Tambi Jalouqa, Managing Partner at Propeller. In the video description, you will find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. And as always, from FWDstart, we have my co-host, Jamie. What's happening this week, Jamie?
Yeah, let's kick off in Saudi then, in that case, Ahmad, where the family offices are kicking the middleman out of the way. So yeah, a group of investors, GCC-based family offices, they've launched a $200 million fund called WAD. The focus is going to be on growth stage startups in the region. So it's bringing together a Saudi investor called Yasser Al-Ghamdi. He's going to be the new fund's CEO, as well as the Al-Majad family office and the Al-Majad group. In terms of Yasser's background, I believe he worked for STC for a number of years. He's a pretty prolific angel investor. I think he claims to invest in something like 180 startups. I got a pain in my hand while scrolling through the list of startups that he's an angel investor in. Sari, Zest Equity, Growdash, to name a couple of them. And each of those startups seem to overlap with some of the 23 companies listed on the fund's portfolio on their website. There's overlap between these startups that he's an angel investor in, and so not entirely sure how that works. But in terms of the portfolio so far, industry focused, you're looking at your F&B, fintech, AI, prop tech, so nothing out of the ordinary as far as that's concerned. They list a number of advisors as well on the site. So you've Nana's co-founders there, and Amal Dokan from 500 Global, who we had on 2 weeks back. Apparently, there's also a couple of other family offices as well involved, but they don't wish to be disclosed in terms of who those are. And just to finish with a quote as well, which I thought was quite interesting, I suppose, which to provide maybe some the rationale behind what they're doing. So this comes from Nasser Al-Majed. He said, the Alliance aims to change the rules of how family offices invest in startups and to reassure the entrepreneurial ecosystem that family offices possess the expertise in exit strategies, IPOs, and financial solvency to lead the tech scene. Discuss.
Okay, so thank you, Jamie. I think we're the middleman that you were talking about in the beginning, but let's see. So let's start with this, actually. As far as I know, family offices typically don't invest directly in startups. They might co-invest, of course, but in general, they invest in VC funds as LPs. What do you think motivated those family offices to pool their money together and create their own VC firm? Do you see this a trend in family offices now? We'll start with Ali.
Yeah, thank you very much, Ahmed. Well, I think a lot of family offices, even prior to that, even when it comes to fundraising, it seems more and more that family offices are demanding more and more co-investment rights. I think this is a trend that has been going on for quite some time. More and more family offices want more direct exposure. They want co-investment rights. They feel like they could make a better decision on, what kind of exposure, what kind of companies that they want to invest in. And I think it's just, taking that to the next step when it comes to, creating their own funds with their own guys that they want there to manage. Family offices now are realizing that VC is an important asset class within their portfolio of investments. They see exits, they see local liquidity, local IPOs, local trade sales. Most family offices do have, conglomerate of different businesses, and they also think about strategic insight, strategic input that these companies can bring up to their own conglomerates or their own families. And, obviously as well, VC is a very personal thing. It's not like public equities or fixed income or capital markets where it's done on a very distant basis. This is very personal. You meet with the startups directly, and everyone likes to think of themselves of knowing how to identify the best startups and whatnot. Obviously, I think 2, 3, 4, 5 years from now, things will mature more and more. We all know that VC is it's a deal flow game, right? And those with the best deal flow typically have access to the best startups, typically make the best investments. And with more players coming in, how where do they position themselves within that deal flow lineup? That's quite crucial. And then they'll figure out who has actually the time for this. This is also a very very timely time costing exercise, and meeting with thousands of startups. But you have someone like Yasser Al-Ghamdi, who's very well known in Saudi. We see him in a lot of cap tables as well from our end. And obviously, VC and fundraising, it's a very personal thing, and good for him. I mean, congratulations for him. He knows how to get access to startups and family offices. There's a lot of trust from both ends. So congratulations to him.
In family offices, usually in MENA, they own big companies, they own banks, they own big food and beverage chains. They're considered potential acquirers for fintech, food tech, and maybe e-commerce companies, right? So now they run a VC firm. Would this increase the M&A activity? On the other hand, would this limit the growth of some startups if those family offices try to control the direction of these companies? And what do you think in general about family offices starting their own VC funds?
Yeah, I just wanted to point something out that this is not the first time that this happens. And this is where I want Hasan's input as well, because similar to Arzan, similar to Dash Ventures in Jordan, Ra'id Ventures, a lot of times VCs are very close to family offices, if not sometimes started by family offices or conglomerates. So I don't think that there is the unique part in Wa'ad, which I'm going to always confuse with Wa'ad, forward. But unless the GP is actually made by like a consortium of the heads of the family offices, maybe, or the IC is made of them, which then for me, it opens up a bucket of separation of aligning interests, and how would it, there would be conflict, because a lot of times the startups might be disrupting the businesses of the original family offices. I know that they can acquire them, but will they acquire them? Will they allow them to grow? It's a lot of different dynamics if they are involved in the investment. If they created a barrier, like a layer of where they just put in the money and give advice and maybe direction as a board of the actual VC, then I don't see any conflict. It's a great thing to have more money, but family offices have been doing this. That's the part where I'm lost. I would love to hear Hasan's opinion on this.
I think, thank you, Tambi. I think that's exactly how the VC industry in MENA region has been developed. Most of the VCs are linked to a family office. Impact 46, ourselves, Dash, Ra'id, a lot of them are linked to family offices. I think if I just go back like 10 years ago, when I wanted to raise my second fund, it was, or a little bit less than 10 years ago. But when I wanted to raise my second fund, I had to go and visit family offices. And at that time, they did not really want to invest in a fund, but they want to pick and choose. So they were a bit reluctant, and they wanted to do it themselves. Yeah. So they want to choose the companies they want to invest in. So once exits happened in the region, then you see that, okay, some of them wanted to lead this and they've created their own VC, or they've partnered up with someone who has the experience in technology and choosing tech startups, and partner up and build their own funds. I think that's exactly how the VC industry has been built. Nothing new, honestly. And Yasser has been doing investments for some time now. So I think it's the progress.
Not all of the VC firms in the MENA region are family office dependent, right? Like MEVP, Sedu, Propeller, Tambi. It's not really related to specific family or family offices. is there going to be some competition between those two types of VCs? Because as far as I know, those family offices have different networks, they have different value add, they have chains of companies. Can they add more value to the startups? And maybe from a founder perspective, which one is better for them? Which one could add more value to them? Which one could be potential acquirer if they're looking at it as corporate VCs? What do you think?
Well, it depends on the expertise that the VC firm has, regardless of how they acquired them. If a VC is created by a family office that the last time they innovated was in the 60s or 50s when they started the family business, I don't see that much related to growing a startup, a technology startup in today's world with everything that's happening in AI and all the other technologies. Sometimes some family offices might not be right, and some of them will be. It depends on what value do they provide today, other than the capital. So I would look at it as a per VC basis, but I can't really talk about all family offices.
So I think family offices are not CVCs. They're not corporate VCs. Yeah, most of them are generalists, opportunistic in choosing their opportunities that they invest in. So they're not really a CVC. There are CVCs that are focused on a specific sector, specific angle. They will add value in one specific industry, and they only look at opportunities that fit in or complement what their own strategy is. So I think in general, family offices in the region are more generalists. So is it going to create more competition? At the current time, I think honestly, with the limited cash, I think it's good. In the future, I believe that yes, that's going to create more competition, but I think it's more healthy competition, and it's spreading the knowledge of the kind of investments that we do to more people, and I think that's how we will develop moving forward.
Yeah, I think Ahmed, to maybe if you frame the question, is there a distinction between VCs that spun off out of family offices and VCs who are, quote unquote, institutional from the get-go? Obviously, a lot of the VCs that spun off out of the family offices are now becoming much more, asset management, typical structured PE firms or VC firms with funds, and they're fundraising, and they have more partners, they have more offices. And even, the VCs that maybe started off with, no ties to a single family office, but what we do is, we try to make sure that we have these, deep connections with our LPs in order to provide, because, startups, they succeed with the support of the VCs. And, on top of that, the LPs, a lot of us are generalist VC firms, and we compete along the same lines, but it's not where the origin is.
Apart from the family office VC funds, let's talk about the competition and venture in the MENA region. Like in the US, big VC firms could lose some deals because of the hot competition. In the MENA region, 10 years ago, we had only maybe 15 VC firms. Now we have 350 VC firms from different types and a lot of angel investors. Are they now competing on deals? I rarely hear any VC saying, hey, I lost a deal to X or Y VC. Are we still friendly, or are we starting to see some competition in the market? Yeah, go ahead, Tambi.
I lost a deal, but I'm not going to mention what it was. Okay. But I lost a deal to a really good VC, and I'm a little bit bitter about it. But next time I'll just have to be better and faster. But yeah, as you said, it doesn't happen a lot. But I think competition is increasing lately.
Hasan, Ali, have you lost a deal to other VCs?
I mean, if we're talking about these days, I think no. We have more time to think about deals. Compared to 2020 and 2021, things are a bit slower for these days. So we can definitely spend more time in looking at the deal and making a decision. But we did lose some deals in the COVID time where things were a bit faster.
Ali, what's your experience?
Yeah, 2021 was crazy. The valuations, the prices, the way VCs and investors are outbidding others. And as Hasan said, right now, I think, yes, there's still room for more VCs, more investors. I mean, from within right now, looking at our own current deal flow and, our next investment committee and whatnot, I think obviously, we're in a position where we have to reject others and we have to accept a few, just because we have that liberty, or, there are more deals that we want to accept. It's just, depending on our limited investment. But I think, yeah, to answer your question, there's still room for more investors. Things are much more calmer and more rational now than 2021. 2021 was fun.
Well, let's move to Africa now. Jamie, what's happening there?
Yes, to Africa. Finally, after 8 long months, the merger between Kenya-based Wasoko and Egypt-based Max AB has finally been completed. In terms of what both of those companies do, essentially they act as distributors for small sort of mom and pop shops across Africa, but they've also in recent years developed or included financial services within that. So e-payments, credit financing, digital services, top-ups, etc. And it looks like there's going to be a lot more of that on the horizon as well. They didn't share any details about the valuation of the merged entity, but it is apparently a near 50-50 split. In terms of the last time they both raised financing, both companies was back in 2022. Max AB, they raised a 40 million pre-Series B that was led by Silver Lake, a US private equity firm, and Wasoko raised 125 million Series B, which valued them at 625. That was led by Tiger Global and Avenir Growth. In terms of how the arrangement is going to work, the co-founders of Max AB and Wasoko, they're going to serve as co-CEOs going forward. And the merged entity, it's going to have the largest network of B2B informal retailers, so about 450,000. Although as per the TechCrunch article yesterday, which announced the completion, it does seem like there's maybe only 200,000 of those actually active.
Thanks, Jamie. I have a lot of questions on this deal. So let's first start with that the merger hints at an expansion into fintech services. Although they're a B2B e-commerce provider or platform, what type of fintech offerings do you think they're introducing and why?
I think, for any B2B business, right, there's always an element of fintech, a little bit SaaS, and a marketplace, right? That's the beautiful. I mean, in theory, that's the beautiful thing about this industry, right? That you could, once you streamline the buy and sell between the buyer and seller, then you could add embedded finance in order to, make more transactions out of that, and then you add some software from both ends. I mean, that's a beautiful thing about B2B. With all these B2B, you should have these three elements. There's some form of marketplace, some form of fintech, and some form of SaaS. And this is the same playbook that is adopted by all the B2B marketplaces.
We've seen very similar companies doing exactly what Maksab was also doing in the region, and they've grown so fast in a very short period of time. I think for them, let's say the FMCG or the retail or the let's say retail B2B part of the business is in a way tough and challenging because of the very low margins. So the unit economics are very tough, where they really need to go and find a way to make money. And the way they from the beginning, the way they think that they're going to make money is by connecting to all of those small retail shops that are in the suburbs or in different towns, and trying to get the data of how much they're consuming from an FMCG supplier, and giving them a loan to be able to grow their businesses. So fintech was definitely a play for them to increase their unit economics and make it more healthy. I think seeing those companies now, there's a lot of those companies who stopped. They're not active anymore. Maksab merging with Wasoko, I think it's a good move because finding those synergies and scaling will allow them to achieve a good, or let's say, I hope they can achieve a unit economics that is considered healthy.
Tambi, go ahead.
Yeah, I was going to say from my end, I'm super excited about, will they push regulators to make it easier for people to create fintechs across borders in Africa? Let's say, if you look at it as a continent, and they're trying to be the continental champion. I don't know, by the way, they said they're going to choose a different name, but let's say Maksab for now is. That should maybe push things towards more seamless interaction, because, it's going to be headquartered somewhere. There are going to be different branches in each country. And how will that all work? I'm super excited about that. And I'm really curious about their IPO strategy, because I feel that will be the next move. Will it be in Saudi? Will it be in London, LSE? I don't know. or maybe Egypt like Fawri. So I'm curious about that.
Is it only for the IPO? I mean, there are two main things here. Hasan, you said that this merger might be for them to find economies of scale and grow faster. And Tambi, you mentioned that it's in Africa, it's a fragmented market, right? It has multiple countries with different regulations, currencies, languages, and consumer behavior. It's very, very complex. A local play might be easier and cleaner in those countries than a regional play. And you said they would be fighting regulators maybe everywhere. But anyway, what do you think the main goals of this merger are? Is it to increase profitability and by sharing resources? Is it to dominate specific markets and beat competition there? Or is it part of a bigger plan for the company to be more attractive to investors because they want to raise a mega round? Or is it just the IPO? What do we think?
I'd love to hear your thoughts, Ahmed, because I know, you and Hasan, you guys made some more investments in the space than us, but for me at least, it never made sense. I mean, it never made a lot of sense why these, B2B marketplaces would actually merge, because, as you highlighted, each country have its own, own suppliers, own distributors, own supply chains, and FMCG is very local, right? It's a lot of it is local manufacturers, local merchants, and even when it comes to fintech, again, local financial institutions and local regulations. So it seemed to me like a lot of these players, it's the first 100 million dollars in GMV seems to be relatively easy to the to reach to the next one, and then just expanding from one country to another, it's another relatively easier way of growth. It seemed like, if I would be very cynical about this, but what are your thoughts about the real synergies when it comes to cross-border expansion?
Yeah, let's hear from our new guest, Hasan from San Francisco. He moved to San Francisco.
I don't know if what I said earlier was clear. I don't know if the internet was good at that time.
I think you were mid-flight, Hasan, so I don't think we wouldn't have gotten
it. Was it clear?
No, we heard it. It was clear. It was clear.
Yeah.
The way I think of this merger is, and I'm a bit pessimistic, but the reason is I know that it has a high burn. Like those companies, all of them, they burn a lot of money on a monthly basis. So merging two companies, they really need to find those synergies. Now, synergies is by making it as one team, localized, but at the same time, it's going to be tough because the unit economics from the gross margin, so which is even before going to the expenses of the team salaries and all of that, that itself is very low. So they need to really be able to scale, so that tiny margin that they get from the suppliers would be positive. And that's the reason why in bringing in or having different business revenue streams is super important to fix the gross margin issue. Most of those companies had to raise in less than a year and very frequently with big amounts, and they've raised at super high valuations due to one reason, and I think it's the way it has been valued based on the revenues and the transaction volumes, which I think is wrong, right? So we ignore what's in the lower part of the P&L and just focus on the revenue. We personally have done 2 investments in this field. So when I say I'm pessimistic, because I've seen the good ones and the bad ones and how they've tried to manage the high burn and the very tough unit economics. So that's my opinion there.
One more question about this story before we move on. The fact that they have now 2 co-CEOs, is that something you see a lot in startups? Is it good, bad? What do you think about that?
I think in this case, it might be a positive. Yeah, we've seen it in companies like Atlassian, but where they're working on the same thing. But in this case, maybe because it's 2 different regions, so you can say, I don't know how they're gonna break it down, but there are more like countries that are Arab-based, maybe other countries that are in the south. So I don't know how they might actually distribute concerns. Someone would lead in this area and the other in that area. Maybe it works But of course, usually it's not a good thing. I wouldn't recommend having two co-CEOs, usually.
It always reminds me of BlackBerry. BlackBerry used to have co-CEOs a long time ago.
They never talk to each other, it seems, until the day they went down. I don't know if they went down. Yeah.
Yeah, there was a movie about the story of BlackBerry, a recent one. Yeah.
There was, yeah.
At MEVP, we have co-CEOs, but it's the same team that has been around for quite some time. It's a different dynamic for us, I feel. I mean, obviously, we're also, it's a financial institution. It's not a high growth company, and it's different.
Some of the founders will get affected by either stepping down or taking a different position, but definitely to find synergies, some of them need to leave. You need to have one captain in a boat. So I'm from that school.
Yeah, I agree. I think having two co-CEOs is creating room for disagreements and internal politics. Some people would, some employees and some board members might prefer one over the other. And I don't know, it's not really directly related to what happened in OpenAI, but there was two top leaders in OpenAI, and the board was split between those two top leaders. I don't know if this will repeat in a company that has two co-CEOs. Anyway, let's move on to the third and last story. Jamie, what's happening?
I told you last week I wasn't covering Web3 for another month. and
oh my God, okay. Let's end now here.
And look at us now. So this time around, it's a Web3 streaming platform, whatever that means. Michael, they've completed a Series A funding round of 10 million, so post-money valuation of $80 million, backed by a ton of different investors. I'm not going through all of them. Demand Investments, top line. And then, as you mentioned in the intro, pretty interesting as well, Ahmad, in terms of Republic.com and the crowdfunding platform. So there's 88 investors through that platform. I think it was $1.3 million in total coming via that particular avenue. So the platform itself was founded back in 2021. So as I mentioned, it's a Web3 content streaming platform. So leveraging blockchain I'm going to give you what they say, a decentralized community-driven ecosystem where both creators and viewers can earn revenue. So it rewards viewers for watching content, and for creators, it has no barriers to entry. So like a YouTube, for example, you can't monetize until you reach a certain number of subscribers or based on the number of pages here, or watches or whatever it is. They have 10 million registered users, 3 million monthly active users across 200 countries. Most of that is concentrated in Asia. It's about 75% of the user base is there. Over 1 million videos on the platform. Something they've really got into in the last couple of months is live sporting events. So they have these streaming rights to ICC and PSL cricket for Pakistan. They also have the English Premier League rights as well in Pakistan. I think they recently just expanded to Egypt and North America as well, and they have sights on a second closing of their Series A in early 2025, apparently.
With video content, we started with, hey, everything is free. There's ads. And then the model shifted to, no, you need to pay. If you don't want to see the ads, you need to pay. And now we went to another extreme. Hey, watch, and we will pay you to watch. So let's go back to Jamie's first question. What is Web3 streaming? How is it different from traditional streaming? Why is it attractive to all of these investors who invested in this round? What's the actual business model here? And how can they get to profitability so soon? They're profitable.
And I have doubts, like how do they calculate it? I really want to know, how do they make the revenue? Are they crypto profitable, or are they like fiat profitable?
That's a good question.
Oh, you mean their token appreciated in value, and that's why they think they're profitable, or are they actually making money?
It's a good question, and it's unclear. It's unclear from what I've read as well in terms of their pitch deck and everything as well. Yeah, there's no sort of level of granularity with regard to.
You don't even understand what they do. Yani Jamie shed some light, but honestly, I was thinking the same. What is Web3 streaming? What's the difference between them and Netflix and YouTube and all the other ones? And if they have exclusive rights to the cricket, maybe that's why people are watching there, not because they're making money or whatever the other value is. they do have exclusive content, and that's how they have the people who watch. Do they stay? Do people watch other stuff? I downloaded, by the way, other than a few movies about blockchain and how amazing it is. Not blockchain, even cryptocurrencies and how amazing it is. I couldn't find valuable, although I'm not a cricket fan. I'm not the right persona, I guess.
It's true, though, to your point about cricket as well. I was looking at sort of a spike in terms of the number of users, and there's just a massive spike. I think it was around the World Cup, and then after that, it goes right back down again. So
it could be a smart move to attract those kind of users because of this big event, and hopefully a percentage of these users would stick around. Not, of course, not all of them, maybe.
I mean, it could be the fact that they identified a major gap in distribution when it comes to, Pakistani cricket, for example. Obviously, you have a huge South Asian diaspora all over the world, and maybe distribution rights aren't as strong in a lot of different regions. So this is, it's Web3. It's, everyone should be able to have access to this and participate. I mean, yeah, I mean, Web3. Even for us for MEVP, the only investment we did is a very vanilla, cryptocurrency exchange. But beyond that, it's with the unit economics of all these different Web3 companies, it's not always clear, but what is clear is content. What we do know that is important for streaming is content, and to have exclusivity to content. And we obviously do know that there's a huge fan base for, these sports sites such as squash and cricket.
Hasan, what do you think?
So I think the idea of being able to create content and earning something from that, and being able to engage and also earn something from that, and like we're used to post things on Facebook, and we just post it. We don't earn anything. Facebook is pocketing most of the money through their ads. Giving that power to the audience to basically engage and make money, I think, or earn from the content that they're creating. I think that's very powerful, honestly. Now, how the company is operating and the revenue model, and I'm not very familiar with that. I haven't seen their details, honestly, so I cannot really comment on how good they are and what's the perspective from my point of view. But I think in general, I want to see how it will play as an industry. And I think it has a great potential.
Yeah, the mission of Web3, I fully agree with that mission. It's not fair for all of the users on TikTok to give all those views. They're watching everything every day, and they're making money for other people. They're not benefiting from it. They're just wasting their time. And at the end of the day, TikTok makes the biggest amount of money, and the content creators make some money. The promise of Web3 is, hey, everyone who's involved in this activity would make some money. And I love that concept.
Isn't that universal basic income? Like, wouldn't it make sense then for me, when I become a user at, let's say, any social media startup, they start giving me $20 every month flat, just because I'm there? Or is it related to attention and giving the illusion of that you are making money, although they're making much more through your attention on specific ads? UBI makes sense as a communist ideology, or like everyone should make money. So something in my heart tells me it's a good thing, but at the same time, I don't believe it works with capitalism, and it would be abused. That's my opinion.
Yeah, if you're talking about the pay or the profits that go to the content creators rather than the platform, you also have these Patreons and Substack and different platforms that have more that offer more power to the users, but again,
sorry, Ali, maybe I spoke. I didn't mean the content creators. I meant the watchers, people who watch.
Yeah.
Because I think that's how Michael works. YouTube gives money to the content creators.
It seems to be a blend. It seems like everyone's getting paid. Not entirely sure how that works.
I guess it's I don't know. Maybe it's a way to drive views, right? That's that's a key difference between blockchain and cryptocurrencies and coins versus social media platforms. For social media platforms, you need to generate the masses in order to offer value. With these blockchain or crypto companies, you offer them the coins immediately in order to bring them in, and then these become valuable, and then through that you kind of push more and more engagement, right? I think it's just a matter of, it could be just the economics to incentivize more and more users, beget more content creators, and then of course that's how you could create a highly engaging platform. So it's just another way of trying to compete with different content creators when you don't have the same budgets.
So talking about sharing the economic benefits of a company, let's talk about crowdfunding. Part of this round was raised on an equity crowdfunding platform in the US, Republic. It included 88 accredited investors. I know this is a special type of crowdfunding where only accredited investors invest, but in the US, there are more than 70 platforms for equity crowdfunding where anyone can invest $100 there, $200 there, and multiple companies. And I know some friends who have a portfolio of more than 100 companies. And for each company, they invested like maybe $200, $300 in these companies. This would give companies a big push in marketing because customers are not only customers now, they're also investors, and we call them investomers. Why is this not picking up in the MENA region? What's happening here? I know there were some attempts, and there are a few crowdfunding platforms in Saudi and maybe one in Dubai, but it's not picking up as much as in the US. What's happening?
Yeah, I think as you highlighted, right, a lot of local investors are investing on Republic and AngelList. So I think it's just, also a lot of our own, local startups are actually listing on, AngelList, for example. So I think it's, once, local infrastructure matures more and more, I think you'll see a shift because, we have the investors, we have the startups that are just using maybe, US or UK based platforms for now, at least a large part of it.
I think when it comes to our region, it's more of, I think the issue of regulations is important to note. And in the States, you'll see one company covering all of the states and with one regulation. For us, if you want to be doing crowdfunding, for example, in Kuwait, you need to be regulated by the CMA in Kuwait. You want to be doing that in UAE, you have to go through sandboxes. And so I think the first challenge for any crowdfunding platform to operate in the region, it's going to be the regulations. And then the second thing is you've seen, for example, like crowdfunding platforms operating in a specific sector, like real estate, but not something that is for startups like that. Eureka is very old, right, in the region, but we didn't see it pick up as what we've seen in the States and all of that. So I think it's mainly regulations.
Yeah, I agree. In the US, the regulations are very advanced. Companies can raise up to $5 million with very, very simple form that you file to the SEC and without even having audited financials or anything. But if you want to raise more, you can raise up to $50 million. But you should have audited financials, and you have a more complicated process to be listed on one of these.
Ahmad, you've also gone through it. So you established a company in a week, 2 weeks, 1 week, and you've opened a bank account in 3-4 days. So that's not there in the region. For you to open a bank account, it will take you 2 months, 3 months to get a license to do whatever you need. Any license that is regulated will take you months and months. So you don't have that. If you have that, then it is possible for you to have a crowdfunding that with a lot of support services. So yeah, I think it's with the infrastructure.
Yeah, Tambi, what's your take on this? And I'll also add one more question. There are some VCs who like to have the companies or their portfolio companies go out there and raise money from the crowds because, especially if it's a consumer tech company, and some VCs would say no, this would complicate the cap table of the company. This would add more pressure on the founders. People are expecting it to become kind of a public company, and they should share information that should not be shared early on in the stages of the company. What do you think?
Well, we never faced it. We have 35 portfolio companies, but none of them actually raised money through a crowdfunding platform. which don't exist a lot in the region. And if they would have, they would most probably, as Hasan said, and Ali, went to Republic or something like that. I don't see the negatives of it, except for how much marketing time you're gonna spend, because usually these things, I don't know if the populist is the word, but people it should be tied to a mission. It should be tied to something, which most probably Myco is. Most of the people who invested are most probably Web3 maximalists, let's say, I'm assuming. That time spent on marketing is maybe not the best time, because you're not marketing to actual customers. You're marketing to micro investors who just need to like what you're doing, and believe in it enough to spend that $200-$300. So it's not something I would advise. I don't know how many, for example, by the way, Replit did it. Didn't need to do it, but part of I forgot how big of a round was, but maybe it was, let's say, 100 million. 1 million was offered on a platform, and it was more of a marketing gimmick. I think I even bought like $500 worth there, because it's like, yeah, we want to back Replit. You want to feel part of that tribe. So I think that's why he did it, but he didn't really need to do it. Amjad, the founder of Replit.
Yeah, I've seen some companies in the US, especially when it's a platform for creators and freelancers. They raised $5 million within a few hours, only from their own community. And they said, we wanted to do this round to reward all of our customers, loyal customers or users, because they have been using the platform for a while, and we want to give them some ownership in this company. And yeah, $5 million in a few hours.
So it's part of, as you said, giving them a piece. It's interacting with your fans or your fanboys, if I can say that. I think that's more than I need to raise 300K now, and I'm running out of money, and I will do a campaign. I think those are not usually successful.
Well, Ali, Hasan, Tambi, thank you so much for joining us today. Jamie, as always, thank you for aggregating all this news for us.
Yeah, thank you so much, guys. Really appreciate your time.